Hello and welcome back to Hank USA. I'm Hank. I've been seeing a lot of great questions in the comments lately, and a lot of new faces joining us, so welcome. That's exactly why I want to come back to a topic that keeps coming up, one that can make a real difference in your monthly budget. Today, we're talking about 5 specific bills that a lot of seniors are legally exempt from paying right now as of June 2026. The frustrating part is that most people who qualify are still paying them. And it's not because they're ineligible, it's because the system isn't built to help you on its own. Nobody from the government mails you a letter to celebrate that you no longer owe something. Nobody calls to tell you the rules changed in your favor. The money just keeps quietly leaving your bank account or your Social Security check month after month, year after year. The whole thing runs on one simple, costly rule. You have to be the one to ask first. The burden is on you to know the rules and act. So I'll walk you through all 5 in plain language with the exact steps and the phone numbers you'll need. If you've been with the channel a while, some of this will sound familiar. But the rules and the numbers changed in a few key places this year, and I want every one of you to have the current, complete picture. It's too important to get wrong. Before the first one, please do me a quick favor. If this helps you, give it a like, subscribe to Hank USA, and turn on the notification bell. When the financial rules for seniors change or a new deadline shows up, I cover it here. Your subscription is how you catch an update that could put money back in your pocket. All right, let's get into it. Let's start with a bill that, for a lot of people, comes straight out of their Social Security check every month, and that many are paying when they legally don't have to anymore. Federal income tax withholding on your Social Security benefits. If you see federal taxes coming out of your Social Security payment, that's almost certainly based on a form called the W-4V, the Voluntary Withholding Request. You probably filled it out at some point, maybe when you first applied, maybe years ago, and chose a flat percentage to withhold, 7%, 10%, 12%, or 22%. Ever since, the Social Security Administration has been applying that percentage to every check. They're just following your last instruction. And here's the key. The SSA is not the IRS. They haven't looked at your latest tax return. They haven't checked whether your income changed. They're an administrator, carrying out your old order month after month. So here's the real question. Is your Social Security income even taxable anymore? For a lot of seniors, the answer is no. Here's how to find out. The IRS uses a formula called provisional income. It takes a little math. First, add up all your income from outside Social Security: pensions, withdrawals from an IRA or 401k, interest, dividends, any part-time work. Next, add any tax-exempt interest, like from municipal bonds. Finally, take your total Social Security benefits for the year and add half of that to the rest. That total is your provisional income. Now, compare it to the federal thresholds. If you're single and your provisional income is below $25,000, your Social Security isn't federally taxable. Not a penny. For married couples filing jointly, that line is $32,000. If you're below those numbers, any withholding you've set up on your Social Security is just a prepayment of a tax you don't owe. You're handing the government an interest-free loan and waiting until tax season to get it back as a refund. Picture what that money could be doing for you every month instead. The fix is simple. Tell the SSA to change your withholding by submitting a new W-4V. You can download it from the IRS website, irs.gov, and choose 0 or a lower percentage. One crucial detail: mail the completed form to your local Social Security office, not the IRS. That's a common mix-up. The SSA runs your payments, so they need the new instruction. It usually takes 30 to 60 days, and after that, your check goes up by whatever was being withheld. Now, the second bill. This one is brand new. It expires in 2028, and it worries me because too many people are either missing it or not claiming the full amount. The big tax law signed in 2025, sometimes called the One Big Beautiful Bill, created a new senior-specific deduction. The best part is that it stacks on top of deductions you already get. It's on top of your standard deduction, and on top of the existing extra deduction for being over 65. Here's how it works. If you're 65 or older by the last day of the tax year, you can deduct an additional $6,000 from your adjusted gross income, which lowers the income you're taxed on. And for married couples, where both spouses are 65 or older, you each get your own. So that's $12,000 for the household, not $6,000 split between you. You claim it on Schedule 1A of your return. It does have income limits. The benefit starts to phase out above $75,000 in adjusted gross income for single filers and above $150,000 for couples filing jointly. Below those, you get it in full. Here's what concerns me based on what I'm hearing in the comments. Because the law is so recent, some tax preparers whose software or training isn't fully updated for the 2025 changes are missing this deduction entirely. So don't assume it gets applied automatically. If you use a tax pro, be direct before you sign. Ask them in these words: did you apply the new senior deduction from the 2025 tax law, the $6,000 one, or $12,000 since my spouse and I are both over 65? Have them show you where it appears on the return. Be your own advocate here. This deduction is only authorized through the 2028 tax year, so you've got a limited window, this year and the next two. Don't let it pass unused. On to bill number 3, and I want to spend the most time here because the dollars are the biggest and the gap between who qualifies and who's actually getting help is enormous. Every month, a set amount comes out of your Social Security check before you ever see it. For 2026, that's the standard Medicare Part B premium, $202.90. That's over $2,400 a year. What millions of seniors don't know is that for them, this doesn't have to come out at all. There's a set of federal programs called the Medicare Savings Programs, or MSPs, designed to pay that premium for you. Most people who are eligible have never heard of them, so the deduction just keeps happening, year after year. The most comprehensive one is the Qualified Medicare Beneficiary Program, or QMB. If you qualify for QMB, it pays your full Part B premium, your Part A premium if you have one, and your Medicare deductibles, coinsurance, and copays. For practical purposes, your out-of-pocket cost for Medicare-covered services drops to about zero. So who qualifies? For 2026, the national income limit for QMB is $1,350 a month for a single person and $1,824 for a married couple. Those are the baseline federal figures, and some states set higher limits, so it's always worth checking. Now, here's a detail that makes a lot of people wrongly count themselves out. The programs don't count every dollar. They use income disregards. The first $20 of most monthly income isn't counted. And if you have any earnings from work, the first $65 of that is excluded too. So your actual gross income can be a bit higher than those limits, and you can still qualify. For example, a single person getting a $1,370 Social Security check might look at the $1,350 limit and assume they're over. But after the $20 disregard, their counted income is $1,350, and they're eligible. If you're anywhere near these numbers, you apply. Let the state run the calculation instead of disqualifying yourself. For those who earn a little more, there are two more tiers: the Specified Low-Income Medicare Beneficiary Program, SLMB, and the Qualifying Individual Program, QI. They don't cover deductibles and copays the way QMB does, but they do cover the full $202.90 Part B premium. For SLMB in 2026, the limit is $1,616 a month single, $2,184 a couple. For QI, it's higher, $1,816 single, $2,455 a couple. There's another big benefit attached to all three. If you're in QMB, SLMB, or QI, you're automatically enrolled in Extra Help for prescription drugs, which cuts your medication costs sharply. In 2026, with Extra Help, you pay no more than $5.10 for a generic and $12.65 for a brand name drug, no matter the pharmacy's sticker price. There's also a recent rule change worth knowing about. As of April 1st, 2026, the federal rules let states count dependent relatives you support who live in your home toward your household size for MSP eligibility, which raises the income limit that applies to you. So if you're financially supporting an adult child or grandchild under your roof, that could be the thing that gets you under the line. One caveat: how quickly each state puts this into practice varies. So the smart move is simply to apply and ask your state how they count your household. Official estimates say roughly 10 million people are enrolled in these programs, while several million more qualify and have never signed up, not because they were denied, but because they never knew to ask. When you call, use these exact words to start. I want to apply for a Medicare savings program. I think I may qualify to have my Part B premium paid. That sentence opens the door. The number is the main Medicare line, 1-800-MEDICARE, which is 1-800-633-4227. Bill number 4 is one that millions of homeowners overpay every year, and it has nothing to do with Social Security or Medicare. It's your property taxes. Every state in the country offers some kind of property tax relief for homeowners who are 65 and older. The catch, same as everything else today, is that it's almost never automatic. The relief comes in a few forms depending on where you live. Some states lower your home's assessed value before the tax is applied, so a home assessed at $300,000 might be taxed as if it's worth $250,000. Others offer a freeze, often the most valuable option. Once you qualify, your home's assessed value is locked in, so even as values and taxes climb around you, your bill doesn't. And some states, like Oregon, Minnesota, and Massachusetts, offer deferral programs that let you stop paying property tax while you live in the home, with the unpaid amount becoming a lien that's settled when the house is eventually sold. A few examples show the range. Texas gives seniors an extra homestead exemption, plus a freeze on the school district portion of the bill. Florida offers sizable reductions for long-term senior residents, and some counties add more based on income. New York lets local governments reduce the assessed value of a qualifying low-income senior's home. You see the pattern? These aren't automatic. Your county assessor knows your age from public records and knows you own your home, but they won't apply the exemption for you. You have to file. And here's the urgency. In most states, the filing window is strict, usually opening in January and closing around April 1st or May 1st. Miss it, and you lose the whole year's savings with no way to recover it. If you've owned your home for years and never applied for a senior exemption, you may have been overpaying the entire time. The fix is simple. Find your most recent property tax bill, which has the phone number for your county assessor's office. Call and ask, what senior property tax exemptions, freezes, or credits am I eligible for? And what's the deadline to apply for next year? When they give you the deadline, write it on your calendar right then. Finally, bill number 5. This is for seniors paying a higher Medicare premium than the standard rate, who may not realize a single free form can sometimes fix it. If your income in 2024 was above a certain level, specifically more than $109,000 for a single filer or $218,000 for a married couple, Medicare adds a surcharge on top of your standard Part B premium. It's called the Income-Related Monthly Adjustment Amount, or IRMAA. And for 2026, the Part B surcharge runs from roughly $81 to nearly $490 extra per month. Per person. Here's the part that catches people. Medicare uses your tax return from 2 years earlier to set your premium. So your 2026 premium is based on your 2024 income. That creates a problem when your 2024 income was unusually high and doesn't reflect your life now. Now, this is where I want to be precise, because there's a lot of confusion about it. There are really 2 different situations. The first is a one-time income spike with no other change. Say you sold a house in 2024 and had a big capital gain, or took a large one-time IRA withdrawal, or did a Roth conversion. If that's all that happened and your income has since returned to normal, you generally cannot appeal that surcharge away. The good news is you don't have to. It falls off on its own once 2024 drops out of the 2-year calculation, and your premium readjusts to your lower income. The second situation is different, and this is what the appeal form is actually for. If your income dropped because of a specific life-changing event, then you can ask Medicare to use your newer, lower income right away. The form is SSA 44, Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. It's 1 page and it's free. Qualifying life-changing events include retirement or a reduction in your work hours, marriage or divorce, the death of a spouse, the loss of a pension, or the loss of income-producing property. If one of those applies and your appeal is approved, Social Security disregards the old income and recalculates your premium using your current lower income. To start, call the Social Security Administration at 1-800-772-1213 and say, "My income has dropped because of a life-changing event, and I want to file Form SSA 44 to have my Medicare premium recalculated." Be ready with documentation that fits your event. A letter showing your retirement date, a final pay stub, or a death certificate, for example. Having it ready makes the whole thing go smoother. All right, let's run the full checklist of all 5. 1. If federal taxes are being withheld from your Social Security and your provisional income is below $25,000 single or $32,000 married, file a new W-4V with the Social Security Administration to stop it. 2. Before you file your taxes, make sure whoever prepares your return applied the new $6,000 senior deduction, or $12,000 for a couple, from the 2025 tax law. Ask them directly. 3. If you're paying the Part B premium, call 1-800-633-4227 and ask to apply for a Medicare savings program to have that $202.90 covered. 4. Find your property tax bill. Call your county assessor and ask about every senior exemption, freeze, and credit, and the filing deadlines. 5. If you're paying an IRMAA surcharge and your income dropped because of a qualifying life-changing event, file Form SSA 44 to have your premium recalculated. And if it was just a one-time income year, remember it will fall off on its own after 2 years. None of these needs a lawyer. None of them costs $1 to file. But every one needs you to start the process, because none of these agencies is going to call and tell you the money is there. Thank you for spending this time with me. This has been Hank with Hank USA. If it helped, please give it a like, subscribe, and share it with a friend or family member on Medicare or Social Security. You never know who needs to hear it. I'll see you in the next one.